Central banks are these weird and opaque institutions that we are told hold immense power over economic outcomes. They're the mystics of money, the high priests of markets. They're the stuff of legends and conspiracy theories. If you've ever made the mistake of telling some drunk guy at a bar that you're an economist, you know what it is to listen to a deranged diatribe about central banks. Here, we'll try to demystify the origins of this institution, giving you a quick look at why central banks arise, what problem governments were trying to solve by establishing them, and how they evolved from their early roles. We will expand more on the modern role of central bank, as they have really expanded their portfolio after the great financial crisis, but this will be the subject of another video. Central banks arose out of necessity, driven by the growing complexities of trade, government finance, and economic stability in the early modern period. The reasons for their creation can be summarized as follows. First, government financing needs. European states in the 17th and 18th centuries faced enormous costs from wars, colonization, and infrastructure development. Borrowing from private financiers at high interest rates became unsustainable, prompting the establishment of institutions to manage public debt more efficiently. For example, the Bank of England was established in 1694 specifically to finance England's war with France, marking the beginning of its role as a public debt manager. Second, currency standardization. Before central banks, private banks and local authorities issued their own currencies, leading to inconsistent standards, frequent counterfeiting, and economic instability. Central banks were created to issue standardized and trusted currency, facilitating trade and enhancing economic stability. Third, stabilizing financial systems. Bank runs and liquidity crises were common, particularly in economies dominated by private banks. This is a somewhat controversial point. There are plenty of economists who argue that free banking was a lot less prone to crisis than its critics seem to suggest. Maybe a chapter on this, if there is sufficient demand, would be useful. There is debate, and it's actually pretty exciting. The first central banks were established to address specific problems, often tailored to the economic needs of their respective nations. A detailed look at the Bank of England, one of the earliest central banks, illustrates this. The creation of the Bank of England, 1694. The Bank of England was established at a time when England faced severe financial difficulties due to prolonged wars with France. The government's ability to borrow was limited, and private financiers demanded high interest rates. Rates were in the 20 to 30% range. Of course, there was a good reason for this. Monarchs, such as Charles II, had defaulted on his loans in 1672, basically telling the goldsmiths that acted as banks at the time to stuff it, but politely. Of course, if you're a goldsmith and the monarch tells you he won't pay, you're royally screwed. Pun proudly intended. William Paterson, a Scottish financier, proposed the creation of a bank to issue loans to the government. In exchange, the bank would receive a royal charter, granting it a monopoly on issuing banknotes and other privileges. The Bank of England's initial capital of £1.2 million was raised through public subscriptions. This capital was loaned to the government in exchange for bonds paying 8% interest per annum. The bank also began issuing banknotes, which represented claims on its reserves of gold and silver. These notes circulated widely, providing liquidity to the economy and enabling the government to fund its expenditures more efficiently. The Bank of England quickly became the primary issuer of a stable, standardized currency, which was essential for trade and economic stability. Its notes gained public trust due to the bank's association with the government and its consistent redemption policies, setting a precedent for modern central banks. So what's the deal here? Why do these new investors actually lend to the government at a much lower rate? I mean, The risk of the government telling these new lenders to stuff it is the same, so they should charge it the same interest rate, right? Well, the clever part of the plan was to give this new bank a monopoly on note issue, and this was a huge deal. Why? Well, because it allowed them the power of making money through seigniorage. How did they accomplish this? When the Bank of England issued banknotes, the notes represented a promise to pay the bearer the equivalent value in gold or silver upon demand. However, the bank did not need to hold 100% of the value of issued notes in reserves. Instead, it kept only a fraction of the value in gold or silver, relying on the fact that not all holders of banknotes would demand redemption simultaneously. Cost of note production. The production of paper notes was cheap, involving printing and administrative costs that were negligible compared to the face value of the notes. Face value versus reserve requirements. If the bank issued £1,000 in notes but held only £500 in gold reserves, it could lend the additional £500 and earn interest on that amount. The difference between the interest earned and the cost of maintaining reserves and producing notes was pure profit for the bank. The Bank of England's ability to issue banknotes introduced the concept of fractional reserve banking, which amplified its seigniorage income, and this was the clever bit of financial engineering, making new money out of thin air. It expanded the money supply. The bank did not need to back every banknote with an equivalent amount of gold or silver. For instance, if the bank held £500 in gold but issued £1,000 in banknotes, it effectively created £500 in additional money, leveraged through lending. The newly issued notes were loaned out and circulated in the economy, earning interest. As long as the public trusted the bank and did not rush to redeem all their notes for gold at once, the bank could profit from this multiplier effect. Other governments eventually figure out that this is a really nice way to borrow cheaply, but they also realize that this is way too powerful a monopoly to give to only one bank, so they bring central banks into the government fold, but they still remain outside of direct government control, in a weird state of being part of the government, but not really. We'll talk more about this in the chapter about modern central banking. Most early central banks were private institutions that operated under government charters. These arrangements allowed governments to benefit from the bank's resources and expertise while retaining some level of oversight. However, as the role of central banks expanded, many transitioned to state ownership to align their operations with national interests. Private ownership. In early central banks, the Bank of England was privately owned when it was established in 1694. Its shareholders included wealthy individuals and institutions who benefited from dividends and other privileges associated with the bank's operations. Similarly, the Bank of Amsterdam, 1609, was managed by merchants and traders, although it operated under the authority of the city of Amsterdam. Transition to state control. Over time, governments recognized the strategic importance of central banks and gradually brought them under public control. For instance, the Bank of France, established in 1800 under Napoleon, was initially a private institution, but was later nationalized. Sweden's Sveriges Riksbank, reorganized in 1668, became one of the first central banks to transition fully to state ownership. When central banks were privately owned, control typically rested with shareholders, often comprising merchants, financiers, and other elites. These individuals and institutions wielded significant influence over the bank's policies, sometimes creating tensions between private interests and public responsibilities. Some examples of private control. The Bank of England. Shareholders had significant control over the bank's operations and decisions. Although the government relied on the bank for loans and currency issuance, it had limited direct oversight during the bank's early years. This arrangement allowed shareholders to profit from the bank's monopoly on issuing banknotes and its role as the government's banker. The Bank of Amsterdam. The bank was managed by a board of directors drawn from Amsterdam's merchant elite. Its policies were shaped to support the city's thriving trade network, prioritizing stability and efficiency. The first bank of the United States, 1791 to 1811. This bank was privately owned, with the federal government holding a minority stake. Private shareholders, including prominent financiers, influenced the bank's operations, leading to criticism that it prioritized elite interests over public welfare. So in modern days, inflation is all we talk about when we talk about central banks, but inflation control was not a primary concern for early central banks. Their initial focus was on stabilizing currency, managing public debt, and ensuring liquidity in financial systems. The concept of actively managing inflation emerged much later as central banks transitioned to fiat money systems in the 20th century. Currency stability over inflation management. Early central banks operated under commodity standards, such as the gold standard, which inherently limited inflation. For example, the Bank of England focused on maintaining the value of its banknotes in relation to gold rather than actively targeting inflation rates. The shift to inflation control. Inflation became a central concern in the 20th century, particularly after the abandonment of the gold standard. Central banks began using tools like interest rate adjustments and open market operations to manage inflation and ensure price stability. But let's talk about the gold standard first. Gold reserves as backing for currency. Central banks held gold reserves to back the paper currency they issued. The relationship between reserves and currency worked as follows. First, issuing banknotes. Central banks issued paper currency as a claim on their gold reserves. For example, under the gold standard, each banknote was redeemable for a fixed quantity of gold, e.g., $35 per ounce in the US before 1971. Second, fractional gold reserves. Central banks did not need to hold gold reserves equal to the total value of currency in circulation. Instead, they relied on fractional reserves, issuing more currency than the gold they held, as long as they could maintain public confidence. Gold convertibility. Gold convertibility ensured that anyone holding paper money could exchange it for gold on demand. This system worked in the following ways. Public redeemability. Currency holders, including businesses and individuals, could redeem banknotes for gold. This convertibility guaranteed that paper money retained its value, as it was essentially a claim on gold. International settlements. Central banks used gold to settle international debts and trade imbalances. Countries running trade surpluses would accumulate gold reserves, while those with deficits would lose gold, creating the self-regulating balance of payments mechanism. Lending against gold reserves. Central banks used their gold reserves as a basis for lending, which contributed to money creation, loans to governments and businesses. Central banks issued loans in the form of paper money backed by gold. Borrowers repaid these loans with interest, creating income for the central bank and expanding the economy. Fractional reserve lending. By keeping only a fraction of reserves in gold, central banks were able to lend out more money than they physically held in gold. This practice multiplied the money supply while maintaining the credibility of gold convertibility. Pegged exchange rates. Under the classical gold standard, 1870 to 1914, central banks maintained fixed exchange rates by linking their currencies to gold. This mechanism allowed them to stabilize currency values. Fixed exchange rates reduced volatility in international trade, control inflation. By restricting the money supply to the available gold reserves, central banks ensured that currency inflation was kept in check. gold convertibility was the cornerstone of money creation during the gold standard era. Here's how it enabled central banks to create money. First, it allowed the expansion of the money supply. Although central banks were limited by their gold reserves, convertibility provided a foundation for controlled money creation. Second, it allowed for confidence-based expansion. As long as the public trusted the central bank to redeem currency for gold, the bank could issue paper money beyond its physical gold holdings. For example, if a central bank held $1 billion in gold but issued $2 billion in banknotes, it created additional liquidity while maintaining public confidence. Lending multiplier effect. Through fractional reserve banking, central banks created more money than their gold reserves. Central banks held gold as a fraction of their total currency liabilities. For instance, a 40% reserve ratio allowed them to issue $2.50 in currency for every dollar in gold reserves. The additional money issued by central banks supported lending to businesses and governments, facilitating economic growth. This all depends on trust, as it does for private banks. In fact, all modern banking, including central banking, is based on trust. There are plenty of cases where people lose trust in private banks and cause bank runs, or they lose trust in central banks and cause people to use any other currency or form of savings, making the central bank powerless. While gold and gold convertibility provided stability and discipline, they also posed limitations. First, limited flexibility. Gold-backed money restricted central banks' ability to respond to economic crises. Second, inelastic money supply. The money supply could not be easily increased during economic downturns, as it was tied to finite gold reserves. This rigidity contributed to deflationary pressures during the Great Depression. This will become a main point of contention in the abandonment of the gold standard. Third, vulnerability to gold outflows. Under the gold standard, countries with trade deficits experienced gold outflows, reducing their reserves and forcing monetary contraction. The history of central banks is a story of adaptation and evolution. Initially established to address specific challenges such as managing public debt and stabilizing currency, central banks have grown into institutions that shape national and global economies. Their transition from private ownership to public control reflects their increasing importance as stewards of economic stability. Central banks issued currency just like other private banks, but they were granted a monopoly on currency issue, which was new at the time and became their main tool through which to control economic activity. Of course, this is a big deal and can turn disastrous if central banks are run by incompetent or evil people. And we'll talk about cases where central banks go berserk and ruin economies in another chapter. But on the other hand, you need someone to have power to smooth out economic fluctuations if they can. To do so, you need to give them powerful tools. There are economists out there that argue that privately issued notes are not as dangerous as all that, and that we're being scaremongers by saying that private bank issued notes can cause problems. One of the more prominent proponents of this theory was Friedrich Hayek. He even wrote an excellent book on the subject. So the idea that you need a central bank to manipulate the money supply is not a closed chapter, but that's another story for another day.